Well, we had a Goldilocks jobs report out of the States on Friday, and the new trading week has got underway with some positive murmurings coming out of the latest US China trade talks being held here in London, which in turn has allowed equities to gain momentum across the board, including the FTSE 100 trading to fresh record highs this morning, while treasuries trade a little bit softer across the curve, and tight ranges continue to dominate the majority of the G10 FX complex. The week ahead brings a relatively light data docket, with tomorrow's US CPI numbers being the most notable event risk for market participants to navigate. Though, of course, we remain on watch for any tariff and trade-related headlines as well. Nonetheless, plenty to discuss on the trade-off this week. Without further ado, let's crack on with the show. So an interesting week for financial markets last week. I'm sure another intriguing week now lies ahead. Joining me to try and make sense of everything that's going on, as always, is my good friend Ryan Littlestone from Forexflow Live and Forex Analytics. Ryan, the sun is shining. The S&P is back above 6,000. US data is resilient. Kyriakos' Wi-Fi connection is holding up. All is right with the world once more, isn't it?
You'd think that, but the morning I've had so far, coming in and seeing some of that UK jobs data and what's our fiscally responsible chancellor's up to next. It's I dread to think what this week's going to bring.
Yes, I mean, I'm sort of loath to make predictions at this moment in time, given how volatile things have become. I mean, the Treasury making the Bank of England look competent the way they've been carrying on over the last few months. And frankly, who would have guessed it? You raise the cost of employing people and the number of people employed falls by the most in a month since the pandemic. What a surprise.
Yeah, who'd have thought that would happen, eh? And but they're not going to tax working people, are they? But just everyone else who happens to work and be people. But anyway, let's stop there before we get right into a real rant about it.
I was going to say, we've got 10 minutes or so before we can start that rant. But, the pool of working people is shrinking quite considerably the way this lot are carrying on. And that looks likely to continue. But anyway, let's crack on with the US jobs numbers, actually, first of all, in topical thunder. So it was, of course, Jobs Day last Friday. Feels like about a decade ago, given how rapidly things are moving at this moment in time. But nonetheless, another US data point comes, another US data point goes, and another US data point points to the underlying economy remaining pretty resilient, despite all of the ongoing trade uncertainty that we continue to see. Headline non-farm payrolls rose by 139,000 in May, a smidgen above the 125,000 consensus, but well above the break-even pace, which is somewhere around 80 to 100,000. And the 3-month moving average of jobs growth, that's now at 135,000, which is also considerably above that break-even pace. And I'd also hasten to add that while neither Ryan nor I got particularly close with our non-farm payrolls guesses, mine was much closer than his. So a win for Mr. Brown on that front, a rare victory.
Whoa.
Oh, go on.
I'm not having that. You broke the rules yet again. Once, look, I was assuming I was going to be using this. I've had an upgrade. I need to tell you. I've now got an official. You can't see that because it's.
Oh, that's a shame, isn't it?
I've upgraded, and I'll even take your number. What's your shirt number? Your name. So I'm ready for you. So no more breaking the NFP rules, please.
I think you need to take those back, mate. Your yellow card's disappearing. You've obviously got some sort of super problem. Dear me. Right. Anyway, where the hell was I? I completely lost my train of thought. And the jobs data, average hourly earnings, they rose by 0.4% on the month, 3.9% on the year. Both a little bit hotter than consensus, but not particularly concerning. Certainly won't cause anyone to worry about upside inflation risks coming from the labour market, although they, of course, remain plentiful, or at least potentially plentiful, as a result of the tariffs that have been imposed. And then in terms of the household survey, unemployment, that held steady at 4.2%. Well, I would just flag, and I got called a nerd for this, for mentioning it to you on Friday, it was a high unemployment figure at 4.2443%. So very, very close to rounding up to 4.3%. Participation That surprisingly fell to 62.4%, back towards those cycle lows that we saw a little bit earlier in the year. But I would take that with a bit of a pinch of salt. The household survey has been really struggling with a drop in response rates, which has introduced extra volatility into that data. So I don't think there's much by way of signal that we can be inferring from that. So I think all in all, it's really a sort of Goldilocks report. Jobs growth, earnings, not too hot, not too cold. It's all just about right. And as a result of that, it's certainly not going to be a game changer for the FOMC, who, of course, meet next Wednesday. They will naturally stand pat in terms of policy and continue with their wait and see approach as they gauge how tariffs are impacting the economic outlook. And frankly, there is nothing in the data, be it the jobs data, be it the GDP numbers, be it the inflation data, that suggests there is an immediate or imminent need for the Fed to be delivering any sort of rate cut at this moment in time, despite, of course, President Trump ranting away on Truth Social, saying that he wants them to cut by a full point and that they shouldn't delay in doing so. There's more chance of pigs flying than the Fed doing that in June, to be completely honest with you. Nevertheless, the last point I would make on this is that the jobs report just does help to further reinforce the bull case for equities. Data remains pretty solid. Earnings growth remains strong. And as we were alluding to in the intro with the US-China trade talks in London, the peak in terms of uncertainty is behind us. And the S&P now back north of 6,000. European markets trading at record highs. I think record highs could be on the cards on Wall Street before we know it as well.
Yeah, they could be, and then I'll get a little lunch in if we see that in the S&P. Just got to mention that one. But
well, consolation, I get a trip to the seaside, so
yeah, exactly.
Tie the handkerchief to my head.
Yeah, string your shorts and your
sandals, all the rest of it.
Yeah, string vest, knotted handkerchief, and your shorts. Yeah, we'll go and build some sandcastles on the beach. Yeah, get you a little bucket and spade. Yes, I'll look forward to welcoming you down to the south coast. But yeah, good report. Yet again, the hard data is not rolling over where we've seen wobbles in some of the private and sentiment data. I still think we are in this window I'd say it's month 2 of my 3-month window, waiting to see if we're going to see some of this uncertainty affect the hard data. I don't think we're out the woods yet. But the one thing I would say about the jobs numbers, those wages numbers year on year, 3.9%, it's been really glued around that 4% mark, which isn't unhealthy, but it does still put a bit of inflation pressure in the pipe. And if you think that we get over all this uncertainty and, trade deals get done, then the US is really in a situation where activity should pick up. We should see a bit of a good news bounce in activity, which tends to bring inflation with it as well, because firms feel more confident putting prices up. Business is good, and they try and make more money out of it. So that can add to the inflation pressure. So for the Fed, they still don't want rates up where they are now, but maybe a struggle either way to get them back down again.
No, that is a very good point, and certainly they won't be giving President Trump his wish anytime soon. That's for sure. I think I don't know. Actually, I'm interested to get your view on this. I reckon Q4 at the absolute earliest for the next cut.
Q4, yeah, potentially. It really, I really can't call it, because you can't call anything for more than 5 minutes in these markets at the moment. So yeah,
I reserve the right to change my mind on that. Let me stress.
Well, you can reserve your right to change it about 50 times between now and Q4, mate. I'm definitely not going to have a lunch bet on that one.
No.
But yeah, we've really just got to swing with the data. I really don't know, because we could get to Q4 and there's 25 trade deals on the table, and the US economy is, running at 3%, 4%, 5% on a recovery bounce sort of thing. And then, inflation's back up 3.5%, 4%. And then what? When do we get a rate cut? It's just not one I can call right now.
Oh, well, there we go. That's nice and optimistic. Why don't you gaze into your crystal ball and look at all the other central banks as well, then, mate?
Yeah, I've got one crystal ball I'm prepared to look in.
And it doesn't work very well.
It's okay. We're nearly halfway through the year, so I thought I'd do a quick review of where we are with all the central banks, and particularly some of the major central banks. Start with the ECB. They haven't officially admitted a pause, but they have touted they've all but won the battle of inflation, and thus they're potentially going into a pause. The issue they now face is whether inflation is going to stick around their target or continue to come lower, and whether the economy is going to keep weak, making it potentially more certain that they're going to be forced to keep cutting, which is still my base case and has been for some time. From here, they'll likely sort of punt decisions until probably September, when we next get their updated forecasts, unless the economy does fall out of bed. I mean, after all, it's going to be the summer holidays and they've all got their holidays to book, so we're not going to get any action while they're all sitting on the beach. Over to the Fed, as mentioned, they continue to find themselves in a bit of a sticky situation. The economy is not rolling over, but government policy uncertainty continues to weigh on firms' future plans. As I said, my view hasn't changed. We're in month 2 of my sort of 1 to 3 month window where we might start to see some effects coming through. But if trade deals are agreed soon, we should see a positive reaction, and the Fed will have to see if that's going to keep them on hold for longer due to that possible higher inflation impact. However, the longer things drag on, they may have a decision to make on whether they need to offer some support if the economy does start rolling over in this next couple of months. Then we move over to the BOJ, and it's very unlikely they're going to drop a hike on us next week, and all the news will be whether they make any changes following their bond review. If they do change or slow QT, expect them to sell it as a financial stability measure for the bond market and not as any sort of easing measure. And it's a big differentiation you need to make there. Now, with the government also now touted to get involved in the super long end, look for maybe some hand-in-hand announcements between both the government and the Bank of Japan on what they do with bonds. Now, wages and inflation are still going their way, but they'll want to see more of the same in the second half of the year, and the same as what they've pretty much seen in the first half of the year before they start thinking about hikes. So look for market rates and wages to turn, as people call it, real positive for a trigger. So that's when wages are above the rate of inflation, meaning they're not negative wage numbers. That'll be the trigger probably for when they next decide to hike. And that's it. That's my review of the 3 banks. I'm sure you want to throw in about the BOE somewhere there.
Well, I was going to say, are you leaving that to me now?
Yes.
Oh, God. Do you know what? I'm going to save the BOE until after I've spoken about the UK jobs data, because they will tie in quite well. But just to cover off the points that you made in reverse order, I mean, we've spoken about the Fed, so we can leave that to one side. BOJ and the Ministry of Finance, I think we've certainly discovered their pain point when it comes to the super long end of the JGB curve. I think we reached that, and the number of sources, stories nodding towards, well, certainly the Ministry of Finance looking to reduce super long issuance, 20, 30, 40-year JGBs, and then the reports that the BOJ, might slow the pace of tapering as well. That's all very market supportive in terms of the rhetoric. I think they would be incredibly foolish if they didn't deliver that now. They very much laid the groundwork to deliver some support to markets. If that isn't forthcoming, then you're going to have a very, very big tantrum on your hands indeed. And then as for the ECB, obviously we heard from the other orange one in Frankfurt last week. The deposit rate lowered by 25 basis points as expected. What was more interesting to me, though, was that now you've got the deposit rate at 2%. They revised down their growth expectations in the near term. They revised down the inflation forecast for this year and next. So you've now got a forecast that says they're going to undershoot the 2% target for probably the next 18 months or so. Yet Lagarde is running around shouting to everyone who'll listen that policy is in a good place and that they remain well positioned, which is kind of central bank speak for we don't think we're going to have to cut anymore. So I think you're right. It'll be interesting what those September forecasts say. But in my mind, I'm kind of going, unless there's an external shock, probably in the realm of trade, the ECB don't really want to deliver any more cuts and up the dovish ante further unless they really are forced to.
Yeah, on that front, this is where central banks can play their accounting smoke and mirrors game, because they cut those forecasts, but they kept their core inflation numbers pretty much unchanged. And that's what they can switch to justify, if they want to stay on hold now, they can justify that by saying, well, inflation may be going below target, but core inflation isn't. So that's why we're staying on pause. And it's a thing central banks do. They use whatever block fits the hole, and at this time it's going to be the core inflation still being above target, and when that comes down, And if that goes below 2%, then that'll be the one to really kick rate cuts coming again.
Yeah, no, you're absolutely right on that one, and I think it's interesting as well the degree of unanimity that we've had in the comments that we've heard since the ECB decision. I mean, from the most hawkish to the most dovish, they're all pretty much along the lines of we're in a good place, we don't really need to do any more. What was it Vilroy said earlier? A favourable zone or something for policy.
Oh, he's been the biggest victory lapper out of the lot of them. So he's the one I'm looking forward to having a bit of egg on his face later in the year.
Oh, God, you do take pleasure in other people's misfortune, don't you? Sometimes.
Well, they get paid for it, so they can take it.
Well, yeah, that is very true. Right, let's move on then to here in the UK. We've got a busy week of UK economic data. But before getting to that, it's worth mentioning that we had yet another shambles here in the UK last week with the Office for National Statistics. Of course, you'll recall that the ONS for, probably about 2.5 years now, have been unable.
They can have a red. They
they pretty well can have a red card. They've been unable to produce labour market data that is accurate, and they might not be able to produce accurate jobs data until 2027. They've also had issues with trade numbers, with GDP growth. We'll add CPI and RPI inflation to that list as well. The ONS confirming last week that CPI in April was overstated. So it was actually 3.4%, not the 3.5% that they reported. And this is because they somehow managed to make an absolute mess of the calculations around the changes in vehicle excise duty, essentially car tax. Now, I genuinely would say that we're at the point of essentially a national scandal here. I mean, we've got a statistics agency that is unable to produce accurate statistics, and I'm not going to feel sorry for them, but it certainly won't be helping either the Bank of England or the Chancellor or the Treasury to make any sort of effective policy here in the UK. Now, as for this week, we have just had, as Ryan alluded to earlier, the latest labour market data. Unemployment up to 4.6% in the month of April, a new high since the middle of 2021. Earnings rising by 5.3% year on year, a little bit cooler than expected, but still incompatible with the 2% inflation target. And what I thought was interesting about the earnings numbers is that actually we now see public sector earnings growth outpacing private sector earnings growth. So maybe you and I, Ryan, should also go on strike for 12 months, and then we might start to get some decent pay rises. The other interesting part of the jobs numbers was the HMRC payrolls change. Now, this should be accurate because HMRC's tax data, you'd like to hope that that's accurate as well. Well, that pointed to employment declining by 109,000 in the month of May, which is the biggest month-on-month decline since the pandemic 5 years ago. On Thursday, we get the latest GDP numbers. The economy expected to contract by 0.1% on the month in April. This is likely a result of basically a whole host of one-off factors being unwound. The March number was supported by tariff front running, by people trying to get ahead of those vehicle tax changes I just mentioned, people trying to get ahead of the stamp duty changes as well. So that is all likely to be given back in the April data that we get on Thursday morning. Fundamentally, none of this is likely to move the needle for the BOE. They are very worried about where inflation is going. Of course, we get the next CPI numbers next Wednesday, the next BOE decision next Thursday, where they are likely to keep rates unchanged. Although I think that jobs data will see the degree of dovish dissent increase. Probably 6-3 is where I'm leaning in terms of the vote at this moment in time, with a 25 basis point cut likely to come in August. But frankly, the BOE are just an absolute shambles at the moment. I think I said in April after the March jobs numbers that they're at real risk of falling behind the curve. Well, I think they're so far behind the curve they can't even see the damn thing at this moment in time. They're just this boneheaded approach of sticking to gradual and careful policy guidance when frankly there's no need to. Recall, of course, in May they revised their inflation forecast lower, growth forecasts lower, unemployment forecasts higher. That's your perfect opportunity to sound more dovish, to get ahead of things, to get a faster pace of cuts baked in. They didn't do it. And I think, frankly, what we're now going to see is a sudden and chaotic situation in the UK economy where we're just going to hit a bit of a wall. And as we were sort of semi-joking about earlier on, you don't really need to worry about the risks of inflation persistence when the economy is shedding 100,000 workers a month and unemployment is going to the moon.
I'm not saying anything. I'm on strike.
Yeah, I mean, me, that's for sure.
Well, let's pick it apart a bit. I mean, the wage numbers, yeah, they've come down a bit, but and you're right what you said about the public sector, and those should actually start rising in. I don't think they were accounted for, but there's going to be another 4% pay rise coming in for public sector workers, in NHS in particular, in a few months. So that's going to be another boost for inflation. As for the data, I just don't know what to do with this data. How can you gauge it when it's not right? We were in this chat in the conversation in the chat room earlier this morning. I thought that 109 is a big number. Let's make no mistake, but I thought it could have been worse. And as you said, that might still happen over the next month or so. Not everyone makes a decision on their workers on day one. So we could be
just on that is also the fourth straight monthly decline. Yeah. So I think you're right. It's probably a combination of some businesses decided to lay workers off in anticipation. Some will have laid off in immediate reaction. And then over the next sort of quarter or so, as the full impact of that begins to bite, and maybe the degree of cost increases that you can pass on to the consumer is less than you expected, that's when we see even more layoffs, I would imagine. So it's kind of a 3-stage reaction.
Yeah, exactly. And it could wash out a bit later on. I mean, you and me both, we're not fans of this government and what they're doing and the results that we're seeing from it. But then, I don't like to get overly bearish on the UK because it has shown time and time again that it can withstand some of these pressures. And we can actually see positive numbers from it. Look at the Q1 data that we got, which, of course, might, be a bit of front-loading data from Q2 and all the trade stuff. But, often when people are too negative the pound, too negative the UK, it can go the other way. So, I'm not going to go kicking and screaming, but the evidence so far suggests that things might get a little bit worse before they start to get better, if they get better. And that's a conundrum, again, the Bank of England's going to have to deal with.
Yes, I would agree with that. And frankly, I will not be holding my breath for things to get better in the short term. But then again, we all know that I am of a slightly more pessimistic, glass half empty persuasion than you tend to be, Ryan. In any case, let's move on, because I believe you want to give us some wisdom.
Well, I'm going to try and give you some wisdom, as good as it is. And yeah, I'm going to do a couple more trading tips. I want to expand on a subject that came up in our chat room recently about trade placement. People think that entering, exiting, and stop placements are just about picking your desired price and placing an order in there. But doing that risks a trade potentially failing when it shouldn't. Now, the key to any trade placement is not to put your orders right on your chart level, right on a technical level. If you look at the euro dollar chart here I've got up, you can see there's two big levels I've highlighted, 112, 115. These are big levels I've spoken about previously a lot of times before. Now, if I wanted to buy exactly at the 112 level and then sometime later maybe have a short at the 115 level exactly on that number, neither level was touched. So any orders I would have put in on those numbers wouldn't have been filled. I've noted that with the white lines you can see on the chart there. That's where the price got to ahead of the level before it then reversed. Now, my rule of thumb for entering at a level that I've identified is to start maybe 10 pips ahead of it. And maybe depending on my strategy, I might do half at 10 pips ahead and then the other half at 5 pips ahead, or split a trade into thirds. Do a bit at 10 pips, do a bit at 5 pips, then maybe do a little bit on the level itself. So in this case, just looking at those charts, the green lines I've got on the chart is where I would have started entering trades against those big levels. Now, splitting a trade, it means there's a risk that you don't get all of your position on, but I'd rather have a little bit of the position on that makes money than nothing at all and seeing the price moving the way I thought it might go. Now, the same thinking should apply for take profit and exit levels. If you have a target level, start taking off your trade maybe, again, 10 to 15 pips before we get there, just in case it doesn't reach your level. Now, stops are slightly different. You need to place your stops under or over a tech level or whatever your desired level is, depending obviously on whether you're long or short. Now, here's a little hint for things like the big figures, for the 00 numbers, like 112, 115. There's a rule of thumb you can use, which we call the 80-20 rule, where price might run stops for a big level like that and go 20 pips above or 20 pips below that level before then reversing. It triggers the stops, has a little dip, and then you see a reversal. So as per the chart, if I was entering against that 112 level, I'd likely have my stop at 111.75. That would be 5 pips under the 80 rule, so the 111.80 level. Likewise, for the 115 short, my stop would be 115.25, 5 pips above the 20 rule level. Now, obviously, nothing is ever guaranteed in trading, but if you use these simple rules, it might make the difference between missing a trade or getting stopped out on a trade unnecessarily and then seeing the price going back your way.
Very good. Hopefully there's some useful nuggets in there. I think the overarching message is one where the absolute last thing you want to do is be correct, but end up not actually getting in the position because you've placed the orders incorrectly. And anything that you can use in terms of tips and knowledge to help solve that issue is, I'm sure, of great use to our viewers.
Yeah, and I can give you a real world example. I had a big level last week, dollar CAD 136.50. I traded against it. I had to stop well down below. I decided to bring my stop up 15 pips below my entry. And where did I get stopped out? Right at the very low of the week. And now we're trading above 137. So, you can have these rules sometimes, and sometimes you can still get pinged out on them. But use them, then you succeed in more trades than you'll fail in.
Yeah, absolutely, and that's ultimately what it's about: stacking the probabilities in your favour as much as possible. You're never going to be right 100% of the time. It's never going to be 100% of your trades that win. It's firstly about making the winners bigger than the losers, but also stacking the odds in your favour as much as possible. Right, with that said and done, let's have some trade ideas of ourselves. I will wait for the titles to finish, and then I will tell you that I'm going to be looking at the S&P 500 this week and keeping it relatively short and sweet. The bull case is firmly intact. US economic data remains resilient, earnings solid, and trade uncertainty behind us. We've also seen all of that prove, catalysts to break north of 6,000, which we have tested yesterday and today and held above. So new highs look to be on the cards. 61.65 is where the record high comes in when we look at the front S&P future. It's about 2.5% away. So the play is relatively simple here, to continue playing this from the long side, remaining a dip bias, certainly north of 6,000, and actually I think north of the 200-day moving average. The bull trend remains intact, and my view is that new highs are on the way, and along with that, a rather chunky lunch bill for me to be settling down on the south coast.
I'm not going to count my chickens just yet. Particularly we've got a case of bird flu down here, so I'm not going to probably count them at all. But that's another story.
Remind me not to order a chicken when I chicken dish when I'm down.
Yeah, you can order a sea chicken. There you go, straight out. Right, I'm going to look at Euro Sterling today. My play of the day, a bit of a short Europe trade. Now this one's probably not. It's probably going to be a bit longer than a day, I'm afraid, because this is a trade I've sort of had my eye on for pretty much since late last year. Now, as I've said many a time, I think the ECB will be forced to take rates lower than they expect or want. And now they've effectively gone into pause mode. I feel now's the time to maybe start trading that. I'm already short a little bit at 84.18, and I've done a little bit more this morning, 84.50. I'm looking to build this trade up to the 85 level, maybe even higher, depending on why we're going up there. Now, the spoiler to this trade might be the BOE having to cut faster if the economy worsens, or indeed not cut at all and stay pretty sticky. But as we prove time and time again, often things are never usually as bad as the press make out in the UK. So if it's positive for the UK, positive for the pound, then that's going to help the trade a bit as well. Now, I don't do profit targets on positions, only places that I would look to maybe take some of the position off if it goes my way. And I'll be looking down into the low 82s as the first area if things are going my way. But short euro sterling from here.
Very good. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you to our producer as well, Kyriakos, for bringing things together as brilliantly as always, eventually. If you have enjoyed the show, please do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, your views on anything that we've discussed. And also, if there's anything you'd like us to chat about in our next episode, which will be in 2 weeks' time. I am out of the office the early part of next week. Of course, a busy week up ahead, though, with the BOJ, the BOE, the FOMC. Rest assured, I will be back for all of that, and we'll be back with another episode of The Trade-Off in 2 weeks' time. In the meantime, a very good couple of weeks ahead, and we'll see you then. Thanks as always for watching. Goodbye for now.